Inflation is a big deal. It impacts everything from the price of bread to your investments. Recently, we've seen some encouraging signs that inflation might be cooling down. This is good news for everyone. Lower inflation means your money goes further. It also gives businesses some breathing room. When inflation is high, businesses have to constantly raise prices just to keep up. This recent slowdown in inflation is a positive development. However, it's important to remember that the economy is always changing. We need to stay vigilant and adapt to new information as it becomes available. The stock market is like a giant prediction machine, constantly processing information and reacting to new data. Investors buy and sell stocks based on what they think will happen in the future, making decisions influenced by news, trends, and economic indicators. S&P 500 futures are a way to get a sneak peek at how the market feels, offering a glimpse into investor sentiment before the market opens. When the news about cooling inflation came out, S&P 500 futures surged, reflecting a wave of optimism among investors. This means investors are feeling optimistic, anticipating better economic conditions and potential growth. They expect the stock market to go up, driven by positive news and favorable economic indicators. Of course, the market can be unpredictable, with many factors influencing its direction. Just because investors are feeling good today doesn't mean the market will go up tomorrow. Sentiment can change quickly with new information. However, S&P 500 futures are a useful tool for understanding market sentiment, providing insights into investor expectations. They give us clues about which way the wind is blowing, helping investors make more informed decisions. The Consumer Price Index, or CPI, is a key measure of inflation. It tracks the prices of a basket of goods and services that consumers buy regularly. The latest CPI report showed that inflation rose by 2.9% in the past year. This is a significant slowdown from previous months. The slowdown in inflation was driven by several factors. Energy prices, which had been soaring, have come down in recent months. Supply chain issues have also eased somewhat. Section 4. Investor Implications, Navigating the Shifting Landscape. So, what does all this mean for investors? First, it's important to stay calm. The market doesn't like uncertainty. The recent slowdown in inflation is good news. It suggests that the Federal Reserve may not need to raise interest rates as aggressively as previously thought. Lower interest rates are generally good for stocks. They make it cheaper for companies to borrow money and invest in growth. However, it's important to remember that the market is always forward-looking. Investors are already anticipating future interest rate cuts. Section 5. Anticipating the Fed's next move. The Federal Reserve is like the conductor of the economy, orchestrating the flow of money and credit to ensure a harmonious balance. It uses interest rates as its primary tool to control inflation and promote economic growth, adjusting them to either stimulate or cool down the economy. When inflation is high, the Fed raises interest rates to make borrowing more expensive. This discourages spending and investment, which in turn slows down the economy and helps bring inflation under control. With inflation showing signs of cooling down, many investors are now expecting the Fed to cut interest rates in the coming months. A reduction in interest rates would be a positive signal for the economy, potentially leading to higher stock prices and increased investment. However, it's important to remember that the Fed is data-dependent and does not make decisions lightly. It will base its decisions on the latest economic indicators, carefully analyzing trends in employment, consumer spending, and other key metrics to guide its actions. As we anticipate the Fed's next move, understanding these dynamics can help us better navigate the financial landscape. Section 6. Staying ahead of the curve. Investing is a marathon, not a sprint. It requires patience, endurance, and a long-term perspective to truly succeed. The key is to stay informed and be prepared to adapt to changing conditions. This means constantly educating yourself and staying updated with the latest trends and news. The recent slowdown in inflation and the surge in S&P 500 futures are positive developments. These indicators can provide a sense of optimism for investors. However, it's important to remember that the market can be volatile. Sudden changes can occur, and it's crucial to be prepared for these fluctuations. As an investor, it's essential to stay up to date on the latest economic news. This includes reading financial publications, following market analysts, and using reliable sources. Pay attention to the CPI report, the Fed's announcements, and other key indicators. These reports can significantly impact market movements and investment strategies. By staying informed and being adaptable, you can position yourself for long-term success in the markets. Flexibility and knowledge are your best tools. Follow me for more insights on navigating the ever-changing world of finance. Together, we can stay ahead of the curve and make informed investment decisions.